This video is for anyone preparing to sit the Kentucky State portion of the Life Insurance Producer exam. Everything here is built around one thing: the rules, numbers, and structures that Kentucky does its own way. We are not going to teach you what a whole life policy is or how underwriting works in general. You are studying that national material somewhere else, and you should keep doing that. What you get here is the Kentucky layer that sits on top of it, because that state layer is where points quietly slip away on exam day. Kentucky has a few features that genuinely surprise people, and we will hit them head-on. So settle in. By the end, you will know what the Commonwealth requires, where the exam likes to set its traps, and which numbers to lock into memory. Start with who is in charge, because the exam often opens there. Insurance in Kentucky is overseen by the Department of Insurance, and that department sits inside a larger umbrella agency called the Public Protection Cabinet. The person who runs the department and holds the real authority is the Commissioner of Insurance. When a Kentucky exam question asks who regulates producers, approves rates and forms, investigates complaints, and can discipline a license, the answer is the Commissioner, acting through the Department of Insurance. Two bodies of law give the Commissioner that power, and it helps to recognize them by name. The first is the statute, the Kentucky Insurance Code, which lives in Chapter 304 of the Kentucky Revised Statutes. When you see a citation like KRS 304 point something, that is the Insurance Code. The second is the regulations, the detailed rules the department writes to carry out the statute, and those are gathered under Title 806 of the Kentucky Administrative Regulations. So statute is Chapter 304, regulation is Title 806. You do not need to memorize section numbers for the exam, but recognizing that two-layer structure helps you place a question instantly. Here is the reasoning behind the setup. The legislature writes broad law, then hands the commissioner the job of filling in the operational detail. That is why so much of what a producer actually does day to day, from how you get appointed to how you handle a replacement, comes from Title 806 rather than the statute itself. To recap this section, the regulator is the Department of Insurance, the leader is the commissioner, the statute is Chapter 304, and the regulations are Title 806. Keep those four anchors in mind, and the rest of the material has somewhere to attach. Next, we will walk through how you actually become a licensed producer in Kentucky, where the state does one thing very differently from almost everywhere else. Studying for your insurance licensing exam? Check out the My Insurance Guide flashcards app, built specifically to help you pass your insurance licensing exam with confidence. Master over 1,000 expertly curated flashcards across every insurance line. Built-in spaced repetition brings back the tough terms right when you need them, and timed practice exams prepare you for the real thing. Click the link below and download today. Now, back to the video. Becoming a producer in Kentucky follows a sequence, and the order matters. Before you can sit the exam, you complete Prelicensing education. Kentucky requires 20 hours of approved Prelicensing study for each line of authority you want. For a life-only license, that is 20 hours. If you were pursuing life and health together, it would be 40 hours, structured as 20 in each line. Say that number with us, 20 hours per line. Your certificate of completion from that course is valid for 12 months, so you cannot let it sit indefinitely and still use it. You also complete a criminal background report, and Kentucky has a specific channel for it. The report comes through the Kentucky Administrative Office of the Courts, the state's court records office, not through a private vendor of your choosing. The exam may phrase this as where a Kentucky applicant obtains the required background check, and the answer points back to the Administrative Office of the Courts. Now, the part that trips up people who studied generic material. In most states, you take your licensing exam through a national testing vendor. Kentucky does not. The Kentucky Department of Insurance administers its own licensing examinations. There is no Pearson VUE, no PSI, no Prometric standing between you and the test. If a question implies you schedule through one of those national vendors, be suspicious, because in Kentucky, the testing authority is the department itself. We will come back to the exam mechanics at the end, but plant that flag now. In Kentucky, the department runs the exam. Kentucky also allows a temporary license in certain situations, issued under the licensing statutes so that someone can act while the full process is completed, often with a sponsoring insurer standing behind them. A temporary license is time-limited and is not a permanent substitute for passing the exam and qualifying in full. Treat it as a bridge, not a destination. Let's lock the section's numbers. Prelicensing is 20 hours per line. The certificate is good for 12 months. The background check runs through the administrative office of the courts. And the exam itself is given by the Department of Insurance, not a national vendor. Hold that last point especially, because it is exactly the kind of state difference the test rewards. Next, we look at what happens once you pass, because a license in Kentucky is something you have to actively maintain. Passing the exam and holding a license is not the same as being able to sell for a company. To represent an insurer, you need an appointment, which is the insurer's formal authorization filed with the state saying you act on its behalf. Kentucky puts a clock on that. The insurer must appoint you within 15 days of the earlier of two events: when you and the insurer execute your agent contract, or when you submit your first application to that insurer. Remember, 15 days. On the back end, when an appointment is terminated, the insurer notifies the department within 30 days of the termination's effective date. Your license then runs on a 2-year cycle, and Kentucky ties the timing to something personal: your birth month. A resident producer's license expires on the last day of the birth month, every 2 years, and the Commonwealth uses the parity of your birth year to decide which 2-year cycle you fall in. If you were born in an even-numbered year, your renewal and your continuing education land in even-numbered years. If you were born in an odd-numbered year, they land in odd-numbered years. So the question to ask yourself is not just which month, but whether your birth year is even or odd, because that fixes your schedule. Kentucky expects you to keep your information current, too. If your address or your legal name changes, you notify the department within 30 days. That 30-day duty shows up in several places in Kentucky's producer rules, so it is worth memorizing as a general habit. When something material about you changes, you have 30 days. What if a license lapses? Kentucky gives a tiered path back rather than a single cliff. There is a short window right after expiration to renew, then a longer window where you can reinstate by getting current on your continuing education and paying a penalty, and then a final window measured in months where reinstatement still works but requires a new application with the background check again. Past 12 months from termination, the door to easy reinstatement closes, and you are treated as a brand new applicant who must redo prelicensing and the exam. The lesson the exam wants you to absorb is that delay gets progressively more expensive, and that 1 year is the outer boundary before you start over. Recapping the numbers that matter here: appointment within 15 days, termination notice within 30 days, name and address changes within 30 days, a 2-year license cycle ending on the last day of your birth month, and the even or odd birth year rule that decides your renewal years. Mix up the 15 and the 30, and you will lose points, so keep them straight. Next, we stay on maintenance and talk about continuing education, including a training rule that is specific and easy to test. Continuing education is how you keep a Kentucky license alive across each 2-year period, and the headline number is 24 hours. Of those 24, at least 3 must be in ethics. Say it with us: 24 hours total, 3 of them ethics. That ethics carve-out is a favorite of exam writers because it is a clean, specific figure, so anchor it now. Kentucky gives you a little flexibility on timing. You may carry forward up to 12 excess continuing education hours into the next 2-year period. So if you overshoot in one cycle, as many as 12 of those extra hours follow you into the next one, where they count as general hours. The number to remember is 12 carried forward, and it is half of the 24-hour requirement, which is an easy way to keep it anchored. Then there are product-specific training requirements that act as gates. These are separate from your general 24 hours, even when they can count toward them. And the key idea is that you must complete the training before you sell that product. The one most likely to appear on a life exam concerns annuities. Before you can sell, solicit, or negotiate annuities in Kentucky, you must complete a one-time annuity training course of at least 4 hours that covers the best interest standard. Remember that figure, a one-time 4-hour annuity course completed before your first annuity sale. A producer who already finished the older annuity training before the best interest rule took effect had to top it up, but for anyone starting fresh, it is the 4-hour best interest course up front. Kentucky has parallel training gates for other products. A producer who wants to sell long-term care insurance under the state's partnership program completes an initial block of training, and then a recurring refresher each license period, and a producer selling federal flood insurance completes a one-time flood course. You do not need the fine print of those for a life exam, but you should recognize the pattern. Certain products require their own training before you may sell them, and the annuity 4-hour course is the one to carry in memory. To recap, the core continuing education requirement is 24 hours every 2 years, with 3 hours of ethics. You can carry forward up to 12 hours. And the standout product gate for life producers is the one-time 4-hour annuity best interest course taken before you sell any annuity. Now we move from maintaining your license to the actual content of Kentucky policies, where the state sets specific timeframes you will be tested on directly. This section is heavily tested, so we will go slowly and repeat the numbers. These are the standard provisions Kentucky requires inside life insurance policies, and the exam loves to swap one state's number for another's. Your job is to know Kentucky's. Begin with the grace period, the stretch of time after a premium due date during which the policy stays in force, even though the payment is late. Kentucky sets that grace period at 30 days. We will say that again, because this is exactly where contamination happens, 30 days. Many states you may have read about use 31 days, and if you studied generic material, you might carry 31 into the exam by reflex. In Kentucky, the statute says 30. If a death occurs during that grace period, the policy is still in force and the claim is payable, with any premium that was due simply subtracted from the proceeds. Here is a quick scenario to make it stick. A premium is due on the 3rd of the month and goes unpaid. The insured dies 20 days later, still inside the grace window. Is the death benefit payable? Yes, because the policy never lapsed. The insurer just deducts the overdue premium from what it pays out. Next is the free look, the buyer's right to return a newly issued policy for a full refund, no questions asked. Kentucky's minimum free look period is 10 days from the date the policy owner receives the policy. Return it within those 10 days, and the policy is treated as void from the start, and every premium paid comes back. Remember 10 days for the free look, and notice the contrast with the 30-day grace period, because the exam will sometimes set those two numbers side by side, hoping you blur them. Grace period 30 days, free look 10 days. Two different protections, two different numbers. Now, reinstatement, which is the policy owner's right to revive a policy that has lapsed for non-payment. In Kentucky, as long as the policy has not been surrendered for cash, the owner may reinstate within 3 years from the date of premium default. To do it, the owner provides evidence of insurability, the insurer finds satisfactory, pays the back premiums with interest, and settles any outstanding loan. The number to memorize is 3 years, and the reasoning is worth knowing. The insurer is taking the risk back on, so it gets to recheck the applicant's health, which is why reinstatement requires proof of insurability, while the original grace period does not. Then, incontestability. After a policy has been in force during the insured's lifetime for 2 years, the insurer generally can no longer contest it for misstatements in the application. Kentucky's incontestability period is 2 years. The purpose is consumer protection. A company gets a fair window to investigate and challenge, but it cannot wait many years and then deny a valid claim over an old application detail. On your exam, if a policy has been in force more than 2 years and the insurer tries to void it over an innocent misstatement, The contest generally fails because the policy has become incontestable. A few more required provisions round this out. There is a misstatement of age rule. If the insured's age was stated incorrectly, the benefit is adjusted to what the premiums actually paid would have purchased at the correct age, rather than the policy simply being voided. And there is the entire contract provision, meaning the policy and the attached application together form the whole agreement, so the insurer cannot later enforce some outside document the policy owner never received. Let's recap the timeframes you must lock in from this section, because these are the highest value numbers in the whole video. Grace period, 30 days. Free look, 10 days. Reinstatement, 3 years. Incontestability, 2 years. Drill those 4 until they are reflexive, and especially guard the 30-day grace period against the 31 you may have absorbed elsewhere. Next, we look at a Kentucky notice requirement that protects owners of larger policies. Kentucky adds a consumer protection step that not every state spells out, and it is the kind of specific rule that makes a good exam question. The insurance code requires insurers to give the owner of a life insurance policy a notice of the owner's rights at certain points in the life of the policy. The department, by regulation, ties this requirement to a dollar threshold. The notice obligation applies to policies with a net death benefit of $100,000 or greater, and insurers are not required to send it for policies below that figure. The why here is practical. A larger policy is more likely to be a significant financial asset for the family, so Kentucky wants the owner reminded of rights that could prevent an unintended loss of coverage. The number to take away is $100,000 as the threshold that turns the notice requirement on. If a question describes a policy under that amount, recognize that the special notice may not be required. At or above it, the owner is entitled to the notice. Quick recap. Kentucky requires a policy owner rights notice, and the trigger is a net death benefit of $100,000 or more. Keep that figure tied to this notice and do not confuse it with the Guaranty Association limits we will cover shortly, which also use $100,000 but for an entirely different purpose. Next, we turn to one of the most heavily regulated activities a life producer performs, replacing an existing policy. Replacement means putting a new life insurance policy or annuity in place, while an existing one is ended, reduced, or borrowed against to fund the new purchase. Kentucky regulates this closely because replacement can quietly hurt a consumer, restarting contestability and surrender charges, and the exam treats the replacement rules as fertile ground. The governing law is in the insurance code at the replacement statute, with the operational detail in the Title 806 regulation on replacement. Here is how the process works in practice. When you take an application, you and the applicant each sign a statement saying whether the applicant has existing life insurance or annuities. If the answer is no, your replacement duties are essentially done. If the answer is yes, the transaction is a replacement, and now specific steps kick in. You must present and read the applicant a required replacement notice, an official form that lays out the consequences of replacing existing coverage, no later than the time you take the application. That notice gives the consumer a clear, written picture of what they may be giving up. There is a companion idea called conservation. When a replacement is underway, the existing insurer, the one about to lose the business, gets a chance to contact its policy owner and make the case to keep the original coverage in force. That is the existing company's right to try to conserve what it has, and the rules set out how and when it may do so. The exam may contrast the replacing insurer's duties with the existing insurer's conservation rights, so keep the two roles distinct in your mind. Finally, record keeping. Kentucky requires that the signed statements, the sales material, and the illustrations tied to a replacement be retained for at least 5 years after the proposed policy terminates or expires. Remember 5 years for replacement records. The purpose is accountability. If a replacement is later questioned, there is a documented trail showing the consumer was properly warned. To recap, a replacement is triggered when existing coverage is being ended or tapped to fund new coverage. It requires a signed statement and a replacement notice given no later than at application. The existing insurer has conservation rights, and the paperwork is kept for 5 years. Next, we go deeper into annuities, where Kentucky has adopted a standard of conduct that raises the bar on what you owe the customer. Annuities get their own rules in Kentucky, and the most important development is the standard you are held to when you recommend one. Kentucky requires a producer recommending an annuity to act in the best interest of the consumer under the circumstances known at the time of the recommendation, without placing your own or the insurer's financial interest ahead of the consumer's. This is stronger than the older idea of mere suitability, and it is exactly the kind of modern, specific rule the exam likes to probe. The best interest standard breaks into 4 obligations, and it helps to know them by name. There is a care obligation, meaning you exercise reasonable diligence, skill, and care to understand the consumer's financial situation, needs, and objectives, and to have a reasonable basis to believe the annuity effectively addresses them. There is a disclosure obligation, meaning you tell the consumer before the sale about your role, the types of products you are authorized to sell, and how you are paid. There is a conflict of interest obligation, meaning you identify and avoid or manage any material conflict that would tilt your recommendation. And there is a documentation obligation, meaning you keep records of what you collected, what you disclosed, and the basis for your recommendation. Care, disclosure, conflict, documentation. 4 obligations, and a question that lists them is testing whether you recognize Kentucky's best interest framework. A crucial nuance the exam can hide here. The best interest duty applies at the time the recommendation is made, not as an open-ended, ongoing obligation for the life of the contract. So if a question suggests you must continuously monitor and re-recommend forever, be cautious. The standard fixes on the moment of the recommendation. Alongside that standard sit Kentucky's annuity disclosure rules. Before or at the time of sale, the consumer receives a disclosure document describing the annuity's guaranteed and non-guaranteed elements, its long-term nature, surrender charges, and the like, and the consumer is given the current buyer's guide, the standardized plain language booklet that explains how annuities work. And recall the training gate we covered earlier. You cannot sell an annuity at all until you complete that one-time 4-hour best interest training course. Let's recap. Kentucky holds you to a best interest standard on annuity recommendations built on 4 obligations: care, disclosure, conflict of interest, and documentation. That duty is measured at the time of the recommendation. The consumer gets a disclosure document and the buyer's guide, and you must have finished the 4-hour annuity training first. Next, we cover the safety net that protects policy owners when an insurer fails. Insurance companies can fail, and Kentucky, like every state, maintains a backstop. It is called the Kentucky Life and Health Insurance Guaranty Association. Every insurer licensed to sell life, health, or annuity products in the Commonwealth must belong to it as a condition of doing business, and when a member company becomes insolvent, the association steps in to continue coverage and pay covered claims up to set limits. The exam tests those limits as specific dollar figures, so we will state them plainly and repeat them. For life insurance, the association covers up to $300,000 in death benefits for any one life, but no more than $100,000 in net cash surrender value. So 2 life numbers travel together: $300,000 of death benefit, $100,000 of cash value. For annuities, the association covers up to $250,000 in the present value of annuity benefits. Say those 3 with us: $300,000 life death benefit, $100,000 life cash value, $250,000 annuity present value. That $250,000 annuity figure is one to guard carefully, because older study materials still float a lower number, and Kentucky's current limit is $250,000. 2 more features matter. First, eligibility runs on residency. To be protected by the Kentucky Association, the policy or contract owner generally must be a resident of Kentucky on the date the insurer is declared insolvent. A non-resident looks instead to the Guaranty Association in their own home state. Second, and this is a classic exam point, producers are prohibited from using the Guaranty Association as a selling tool. You may not advertise or make a sales pitch built on the promise that the association stands behind a policy. The reasoning is that the safety net exists to protect consumers, not to let a producer downplay the importance of choosing a financially sound insurer in the first place. On your exam, an agent who reassures a prospect by pointing to Guaranty Association coverage to close a sale is committing a prohibited practice. Recapping the figures: $300,000 in life-death benefits, $100,000 in life cash value, and $250,000 in annuity present value, with coverage tied to Kentucky residency at the time of insolvency, and a flat ban on using the association in your sales pitch. Next, we cover the broader rules of conduct that govern how you treat customers and competitors. Kentucky's insurance code lays out conduct that is forbidden for anyone selling insurance, and while many of these prohibited practices mirror national norms, the exam expects you to recognize them by their Kentucky labels and to know they carry real consequences here. Let's define the major ones in matched terms so they are easy to tell apart. Misrepresentation is making a false or misleading statement about a policy's terms, benefits, or an insurer's financial condition. Twisting is a specific kind of misrepresentation, using false or misleading statements to convince someone to drop one policy and replace it with another, to that person's disadvantage. Churning is closely related but stays inside one company, generating a new sale by tapping the values of the customer's existing policy with that same insurer, again to the customer's detriment. Don't confuse twisting with churning. Twisting moves the customer between companies on false pretenses. Churning recycles value within one. Rebating is offering something of value not stated in the policy, a share of your commission or a gift, to induce someone to buy. Defamation is making false statements that damage another insurer or producer. And unfair discrimination is treating people in the same risk class differently on price or terms without a sound actuarial basis. Each of these is prohibited, and each is a favorite multiple-choice trap because the terms sound alike. Beyond the sales floor, Kentucky imposes affirmative reporting duties on you as a licensee. If another state or a regulator takes administrative action against your license, or if you face certain criminal charges, you must report that to the Kentucky Department within a tight window, and the rule of thumb to carry is the familiar 30 days. The Commissioner also has clearly defined grounds to place a license on probation, suspend it, revoke it, or refuse it, including providing false information on an application, fraudulent or dishonest practices, and, importantly, failing to meet that continuing education requirement we discussed. The through line is that your license is a continuing obligation, and silence about a problem can itself be a violation. Kentucky also has specific protections aimed at members of the military, with rules forbidding deceptive practices and unsuitable products in sales to service members. You do not need the details for a life exam, but recognize that the Commonwealth singles out that group for extra protection. Let's recap the conduct rules. Misrepresentation, twisting, churning, rebating, defamation, and unfair discrimination are all prohibited, and you should be able to tell twisting from churning by whether the customer is moved between companies or kept within one. You have affirmative duties to report administrative and criminal actions, generally within 30 days, and the Commissioner can discipline a license on enumerated grounds, including a continuing education failure. Next, the final content section, where we pull together exactly what test day looks like in Kentucky. We saved the mechanics of the exam itself for last, and the most important fact you already know. In Kentucky, the Department of Insurance administers the licensing exam directly, not a national vendor. Schedule it through the state system after your application is processed, and plan to test at an approved location because Kentucky does not offer the remote, take-it-at-home option you may have heard about in other states. Now, the figures. A Kentucky producer licensing exam contains 150 questions, and you are given 190 minutes to complete it. To pass, you must answer 70% correctly. Say those with us: 150 questions, 190 minutes, 70% to pass. The exam is computer-based and multiple choice, and it blends general insurance knowledge with the Kentucky-specific law you are studying right now. So the state material you have been drilling is a defined slice of that 150-question total. On cost, plan for a $50 fee for each examination. If you do not pass and need to retake, that is another $50, and Kentucky lets you retake the exam as many times as you need, with no lifetime cap on attempts, though you will pay the fee each time, and you cannot test again the very same instant. Keep in mind the 12-month shelf life of your Prelicensing certificate, which sets the outer boundary for getting through the process. On test day, bring a valid government-issued photo identification and your certificate of completion. Without both, you will not be allowed to test, so treat them as non-negotiable. Recapping the logistics. The Department of Insurance runs the exam. It is 150 questions in 190 minutes. You need 70% to pass. Each attempt costs $50, and you must bring photo identification and your certificate of completion. Hold the 150, the 190, and the 70. And remember that the department, not a national vendor, is the testing authority. That single fact is one of the most distinctly Kentucky things on the whole test. You have now covered the Kentucky layer end to end, so let's sweep the must-memorize numbers one last time, because this final pass is the one that tends to stick. Prelicensing is 20 hours per line, and your certificate lasts 12 months. Continuing education is 24 hours every 2 years, 3 of them ethics, with up to 12 hours carried forward, and your 2-year cycle ends on the last day of your birth month, keyed to whether your birth year is even or odd. Appointments happen within 15 days, and material changes and reportable actions get reported within 30 days. On the policy side, hold the 4 big time frames: grace period 30 days, free look 10 days, reinstatement 3 years, incontestability 2 years. Guard that 30-day grace period against the 31 you may have learned for other states. The Policyowner rights notice turns on a $100,000 net death benefit. Replacement records are kept 5 years. Annuities carry the best interest standard and a one-time 4-hour training. The Guaranty Association covers $300,000 in death benefits, $100,000 in cash value, and $250,000 in annuity present value. And the exam itself is 150 questions, 190 minutes, 70% to pass, given by the Department of Insurance. You are more ready than you think. Kentucky's state portion rewards exactly the kind of focused number work you just did. And if those figures are sitting in your memory, the state questions on your exam should feel less like guessing and more like recognition. Go in steady, read each question for the Kentucky-specific catch, and trust the work you put in. If this walkthrough helped, a like and a subscribe genuinely helps other Kentucky candidates find it, and it tells us to keep building these state guides. Now go pass your exam.